The numbers are so vast they have ceased to feel real. They appear on screens in financial terminals, in the ledgers of central banks, and in the quiet calculations of treasury departments, yet they represent a burden so immense that it is quietly reshaping the architecture of global power. The United States national debt has crossed $35 trillion, a figure that is accelerating at a pace that alarms even the most cynical of economists. But behind the sterile arithmetic of deficits and bond yields lies a far more dramatic story, a slow, grinding, and potentially irreversible shift in how the world finances itself. For 80 years, the American dollar has been the undisputed king of global commerce, the reserve currency of the planet, a privilege that allowed the United States to live beyond its means. Now, for the first time since the Bretton Woods system was established in the shadow of the Second World War, that privilege is being questioned not just by rivals like China and Russia, but by historically neutral financial hubs and some of America's oldest allies. To understand the gravity of the current moment, it is necessary to look back to the summer of 1944. As the Allied forces were landing in Normandy, delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. The world was in ruins, and the architects of the post-war order, most notably John Maynard Keynes and Harry Dexter White, were tasked with creating a financial system that would prevent the economic chaos that had led to the rise of fascism. The solution was to peg the world's currencies to the US dollar, which was, in turn, pegged to gold at $35 an ounce. This was not an arbitrary decision. The United States held the vast majority of the world's monetary gold, and its industrial base was the only one left standing intact. The dollar was not just paper. It was a receipt for gold, and the world trusted it. This system held for nearly 3 decades, but it was brittle. By the 1960s, the cost of the Vietnam War and President Lyndon B. Johnson's Great Society domestic programs had forced the U.S. to print far more dollars than it had gold to back. Foreign governments, led by France under Charles de Gaulle, began to look at their dollar reserves with suspicion. De Gaulle famously sent a French Navy cruiser to New York to physically collect France's gold in exchange for dollars, a symbolic and practical blow to American financial hegemony. The pressure became unsustainable. On August 15, 1971, President Richard Nixon appeared on national television to announce that the United States would temporarily suspend the convertibility of the dollar into gold. It was a seismic shock, what became known as the Nixon shock. Overnight, the world's money became fiat currency, backed not by a physical commodity, but by the full faith and credit of the U.S. government. What happened next was arguably the greatest financial magic trick in history. Instead of collapsing, the dollar became even more powerful. This was due to an agreement struck with Saudi Arabia in 1974. The United States agreed to provide military protection and investment opportunities to the kingdom, and in return, Saudi Arabia agreed to price its oil exclusively in US dollars. Because the entire industrialized world runs on oil, every nation on Earth suddenly needed to hold dollars to buy energy. This was the birth of the petrodollar. It transformed the dollar from a currency backed by gold into a currency backed by the world's insatiable thirst for crude oil. It allowed the United States to run trade deficits and accumulate national debt without facing the immediate consequences that would cripple any other nation. The United States could simply print money to buy goods from Japan, Germany, and later China, and those nations would recycle those dollars back into U.S. Treasury bonds. For decades, this cycle was described as a mutually beneficial equilibrium, but it was, in reality, an empire of debt. The financial crisis of 2008 marked a turning point in this narrative. The collapse of the housing market revealed the fragility of a system built on excessive leverage. The United States government stepped in to bail out the banks, using tools like the Troubled Asset Relief Program, or TARP, and the Federal Reserve slashed interest rates to zero while initiating quantitative easing. This was a policy of printing money to buy government bonds, effectively monetizing the debt. While these actions prevented a second Great Depression, they also fundamentally altered the perception of U.S. fiscal responsibility. For the first time, serious voices in international finance began to ask, if the U.S. can print money to solve its problems, what is the real value of the dollars we are holding? The anxiety deepened significantly in 2022. Following Russia's full-scale invasion of Ukraine, the United States and its European allies deployed what many consider the most powerful economic weapon in the modern arsenal: the freezing of Russian central bank assets. The United States finds itself in a precarious loop. To maintain its global influence, it must spend enormous sums on its military, which costs nearly $1 trillion a year when accounting for all defense-related spending. To fund this, alongside Social Security, healthcare, and interest payments, the Treasury must issue new debt. The Federal Reserve has raised interest rates to combat inflation, which was partly caused by the supply chain disruptions of the pandemic and the trillions of dollars of stimulus injected into the economy in 2020 and 2021. But higher interest rates are a double-edged sword. As interest rates rise, the cost of servicing the national debt rises. By 2024, the United States was spending more money on interest payments on its debt than it spent on its entire defense budget. This is a stunning and unsustainable threshold. The government is borrowing money just to pay the interest on the money it has already borrowed. This dynamic has consequences that are acutely felt on Main Street. The value of the dollar is not static. While the dollar has remained strong against other currencies due to the Federal Reserve's tight monetary policy, its purchasing power has been severely diminished. Inflation erodes the savings of ordinary citizens. The cost of housing, food, and energy has skyrocketed, leading to a crisis of confidence in the economic stewardship of Western governments. When the government runs a massive deficit, it often relies on inflationary financing, which acts as a hidden tax on the population. The poorest households are the most vulnerable, as they spend a higher percentage of their income on necessities. The social contract that has held American society together is strained. Populist movements on both the left and the right have gained traction by attacking the globalist financial order and the elites who benefit from it, often without offering viable economic alternatives. International observers and economists are deeply divided on the future of the global financial system. There are those who argue that the reports of the dollar's demise are greatly exaggerated. They point to the fact that the dollar still constitutes roughly 58% of global foreign exchange reserves. The euro, despite representing a large economic bloc, remains mired in its own political complexities. The Chinese renminbi, while growing, still represents a fraction of global transactions, and Beijing's strict capital controls prevent the free flow of the currency, a prerequisite for true reserve status. These analysts argue that the U.S. Treasury market remains the deepest and most liquid market in the world, offering a safe haven that no other asset can match. Even in times of crisis, money flows into the dollar, not out of it, a phenomenon seen repeatedly during global shocks. However, a growing chorus of analysts suggests that this is a game of diminishing returns, a slow bleed rather than a sudden collapse. They argue that the world is not abandoning the dollar entirely, it is simply building a parallel system. This is the multipolar currency thesis. In this future, the world does not adopt a single new king, but rather fragments into regional blocks. The Eurasian bloc trades in yuan and rubles, the Gulf trades in a basket of currencies, Europe attempts to bolster the euro's role in commodities, and the Americas remain anchored to the dollar. This fragmentation would reduce the United States' ability to fund its deficits cheaply. If foreign central banks stop buying U.S. treasuries, the U.S. government will have to rely on domestic buyers, driving up yields and making the debt burden even more expensive. This would eventually force Washington to make an impossible choice: drastically cut military and social spending, or default. The technical mechanisms of this shift are worth understanding. The SWIFT system, based in Belgium, is a messaging network that allows banks to securely transmit transaction information. It is not a settlement system, but it is the nervous system of global finance. When the West cut off Russian banks from SWIFT in 2022, it was described as firing a financial nuclear weapon. This action accelerated the development of alternatives. China's CIPS system is growing rapidly. The Bank for International Settlements, the central bank of central banks, is leading a project called Project mBridge, which is a collaboration between the central banks of China, Hong Kong, Thailand, and the United Arab Emirates. This project uses central bank digital currencies, CBDCs, to settle cross-border payments instantly, bypassing the traditional correspondent banking system that relies on the dollar. If central banks can exchange digital currencies directly with each other, the need to hold a third-party currency, like the dollar for trade settlement, diminishes significantly. Furthermore, the physical manifestation of wealth is shifting. Central banks around the world have been buying physical gold at a record pace. In 2022 and 2023, central banks bought over 1,000 tons of gold annually, a level not seen since the 1960s, when the Bretton Woods system was under strain. Poland, China, Turkey, and India have been among the most aggressive buyers. Gold is the historical asset of last resort, the one currency that cannot be frozen or printed. This flight to gold is a direct reflection of the world's declining trust in the U.S. government's ability to manage its finances. It is a quiet, physical hedge against the abstraction of sovereign debt. The political landscape in the United States only amplifies these concerns. The debt ceiling standoffs that have become a recurring feature of American politics have, on several occasions, brought the nation to the brink of a technical default. Credit rating agencies, such as Fitch and Standard & Poor's, have already downgraded the United States credit rating in response to fiscal mismanagement and political dysfunction. Each downgrade is a small crack in the facade of invincibility. The markets have largely shrugged off these downgrades, but the erosion of confidence is cumulative. If the United States ever did default, even for a day, the impact on the global bond market would be catastrophic. The risk-free rate of the world would become the riskiest asset on the planet, and the liquidation of U.S. assets would trigger a global depression. The story of the debt ceiling is a microcosm of the larger problem. The debt ceiling is a legislative limit on the amount of national debt that can be incurred by the U.S. Treasury. It is a relic of a bygone era, intended to streamline financing for World War I, but it has become a tool for political brinkmanship. Every time the ceiling is approached, the Treasury must employ extraordinary measures to keep the government funded. If these measures are exhausted, the government could miss payments on its bonds, pensions, or military salaries. The mere threat of this has, in the past, caused stock market volatility and increased borrowing costs. The world watches these political battles in Washington with a mixture of disbelief and anxiety. The fate of the global economy is being held hostage by domestic political squabbles over unrelated policy issues. The consequences of this fiscal instability are not confined to the world of high finance. A decline in the dollar's status has real-world implications for the average citizen in the United States and abroad. For Americans, a weaker dollar makes imported goods more expensive. It reduces the standard of living as the cost of living rises faster than wages. It makes it more difficult for American companies to invest abroad and for the government to project power. For the rest of the world, a weaker dollar initially makes their exports to the U.S. cheaper, potentially boosting their economies, but it also creates volatility. Countries that hold large dollar reserves, like Japan, see the value of their savings diminish. The shift to a multipolar currency system could lead to greater fragmentation of global trade, as regional blocs prioritize internal transactions over global efficiency. This would likely lead to higher costs for consumers everywhere and a slower pace of global economic growth. The timeline of this transition is uncertain. It will not happen overnight. Empires of currency do not fall in a day. They fade over decades. The British pound remained a significant reserve currency for half a century after the sun set on the British Empire. The dollar's decline may be equally slow, but the direction of travel seems clear. The world is hedging its bets. No nation is making a dramatic declaration of independence from the dollar. They are simply building the infrastructure to survive without it, should the need arise. They are creating payment networks, accumulating gold, and signing bilateral currency swap agreements. This is the quiet architecture of a post-dollar world, and it is being built not out of malice, but out of prudence. The future will likely be defined by a crisis of confidence. The specific trigger could be a failed Treasury auction, where the U.S. government struggles to find buyers for its debt. It could be a geopolitical event where the U.S. attempts to freeze the assets of a major power like China, forcing Beijing to retaliate by selling its U.S. Treasury holdings. It could be a technological breakthrough, such as the widespread adoption of a CBDC system that bypasses the dollar entirely. Or it could simply be the slow grind of demographics, as an aging U.S. population places unsustainable pressure on social welfare programs, pushing the deficit to levels that even the most loyal foreign buyers cannot ignore. The story of the national debt and de-dollarization is a story about trust. Money is, at its core, a psychological construct. It has value because we believe it has value. The American dollar has enjoyed the benefit of the doubt for nearly a century. It has survived wars, assassinations, financial crises, and political scandals. But trust is a fragile asset. It is built slowly and lost quickly. The reckless expansion of the U.S. balance sheet, the willingness to use the financial system as a weapon, and the persistent political dysfunction in Washington are eroding that trust at an alarming rate. The world is not moving away from the dollar because it wants to, it is moving away because it has to. It is a rational response to an unsustainable trajectory. When the history of the 21st century is written, the decision to weaponize the dollar and the failure to manage the national debt may well be seen as the strategic pivot that closed the era of American financial supremacy, not with a bang, but with the silent drift of capital towards safer harbors.